Everything going forward needs to be in a limited company. And the first thing you need to do is look at where your money is coming from. So it's either you're already taxed money, you have retained earnings in a company, or you have a group set up. The first thing you do with that scenario is look at how much tax you're paying. If you're a basic rate taxpayer or a higher rate taxpayer or an additional rate taxpayer, it's a completely different plan. How much of a capital gain is there? Is also because a lot of the time it's better to let that property go if it makes sense and then redeploy the capital in a limited company. So in that scenario, you'd sell it, you'd pay your capital gain if there is any, you take that capital, introduce it to your limited company as a director's loan. That money's owed back to you at any point, so it's super flexible, and you invest through the company. Sometimes there's a massive capital gain, so you wouldn't want to do that. It all depends on your long-term plan. Sometimes people will reduce their personal income to bring them back down to a basic rate taxpayer because you get a 20% tax credit anyway. So if you get a 20% tax credit and you're a basic rate taxpayer, it's okay. It's when you become a higher rate taxpayer and you've got this large interest to pay on properties in your own name, it becomes an issue. So first of all, look at what the capital gain would be if you sold it. Is there any sentimental value? There shouldn't be, because if it's an investment, it should be a spreadsheet exercise, and you could potentially leave it in your own name and carry on investing through the limited company, or you sell it. They're the most two common answers. Very rarely does it make sense to sell it to your own company because you're going to trigger a stamp duty surcharge, and if you're purchasing property in a limited company, you've got that 5% additional surcharge there. So you don't want to sell it to yourself. It's a dry tax charge and it very rarely makes sense.